Picture this. You wake up tomorrow and every single debt on the planet is paid off. Every mortgage, every student loan, every government bond, every credit card balance. Gone. Zero. Clean slate. You'd think that would be a good thing. The world is finally free from the shackles of borrowing. It would actually cause the entire global economy to collapse within weeks, and that is not an exaggeration. The thing is, we've been taught to think of debt as a failure, as something you fix, as a problem to be solved. But debt isn't a bug in the system. It's the system. It's the engine. It's what the whole machine runs on. And once you understand that, you can't unsee it. So let's start at the beginning, not with central banks or bond yields or any of that. Let's start with a bakery. You want to open a bakery. You've got the recipe. You've got the dream. But you don't have the oven. An oven costs $20,000. You don't have $20,000, so you go to the bank. The bank lends you $20,000. You buy the oven, you make the bread, you sell the bread. Over 5 years, you pay the bank back $24,000. That extra $4,000 is interest. That's their fee for trusting you before you'd proven yourself. Now here's the thing nobody stops to think about. Where did the bank get that $20,000? Here's the uncomfortable answer. They mostly made it up. Not fraudulently, not illegally. It's actually how banks are designed to work. When a bank issues you a loan, it doesn't go into a vault and count out $20,000 in bills. It types a number into a computer. Your account now says plus $20,000. Their ledger says minus $20,000. Money that didn't exist 5 minutes ago now exists. This is called fractional reserve banking, and it's the foundation of modern finance for over 300 years. The bank is required to hold only a fraction of deposits in reserve. The rest they can lend out. In many countries, that reserve requirement is now effectively zero, which means the amount of money a bank can create is theoretically enormous. So when you hear someone say the government is printing money, they're usually only half right. The bigger printer is the banking system, and it prints by lending. Now scale that bakery up, way up. Instead of one oven, you're building a highway or a hospital or an aircraft carrier. A highway might cost $10 billion. No government has $10 billion sitting in a jar somewhere, so the government borrows it. They issue what's called a bond. Think of a bond as an IOU with a date stamp. It says, lend us $10 billion now, and in 10 or 30 years, we'll pay you back, plus interest. Who buys these bonds? Other governments, pension funds, insurance companies, wealthy individuals, the central bank. And when the bond matures, the government pays it back, usually by issuing new bonds to cover the old ones. You heard that right. You pay off old debt with new debt. The United States has been doing this since 1790. The national debt has literally never been fully paid off. And here's what makes that genuinely strange. The U.S. economy is still the largest on Earth. Japan's debt is over 250% of its GDP. The country owes more than twice what it produces in a year, and yet it's still functioning, still issuing bonds, still being taken seriously by global markets. Why? Because debt at a national level is not really about paying it all back. It's about managing it, servicing it, staying credible. The question is never, can they pay it all off? The question is, can they keep making the payments and stay trusted? It's a treadmill, not a finish line. Here's where it gets interesting and a little uncomfortable. Consumer debt, government debt, corporate debt, they're all connected through something called the credit cycle. And the credit cycle is basically the economic weather system. When things are good, credit is cheap, interest rates are low, borrowing is easy, businesses expand, people buy homes, governments fund infrastructure, the economy grows, everyone feels good, more credit gets issued, asset prices rise. And because asset prices rise, people feel wealthier, so they borrow more against those assets. This is called a credit expansion. It can go on for years, sometimes decades. But here's the catch. All of that new money created through lending has to be paid back with interest. And interest means that the total amount owed is always growing faster than the principal. The economy has to keep growing just to stay ahead of the debt it created. When it doesn't grow fast enough, the cycle turns. Defaults rise, banks get nervous, credit tightens, businesses cut back, people lose jobs, less spending, less tax revenue. Governments borrow more to stimulate, which adds more debt, which requires more growth to service. The spiral can go either direction, and the direction it chooses depends enormously on confidence, on what people believe everyone else is going to do. This is why economists say things like animal spirits, because sometimes the whole system runs on vibes. 2008 is the textbook example. The housing market didn't collapse because everyone suddenly got poor. It collapsed because confidence did. Banks stopped trusting each other. The interbank lending market froze. And within weeks, a problem in American mortgage securities had shattered financial systems in Iceland, Ireland, and the UK. That's how tightly the debt web is woven. So here's the question you should be sitting with. If debt can spiral, if it can collapse systems, if it requires endless growth to remain sustainable, why do we keep doing it? Why is this the default architecture of modern economics? Because the alternative is slower, much slower. An economy that only spends what it has saved first is an economy that moves at the speed of savings, which is slow. Savings accumulate over years. Debt can mobilize value from the future and use it today. The highway gets built now, the business opens now, the research gets funded now. You're essentially borrowing from your future self or your future country and betting that by the time the bill comes due, you'll be better equipped to pay it. Sometimes you're right, the highway creates commerce, the business becomes profitable, the research becomes a cure, the investment pays dividends larger than the interest. Sometimes you're catastrophically wrong, and the bill comes due before the bet paid off. Here's what most people miss. Debt doesn't just fund things. Debt itself is an asset. When a bank lends you $20,000, that loan is on the bank's balance sheet as an asset. When the government issues a bond, that bond is held by pension funds as a safe store of value. The world's entire financial system is built on layers of debt instruments that other institutions hold as their reserves. There are roughly $300 trillion of debt outstanding in the global financial system right now. That's 300,000 billion. It's a number so large it stops feeling real. For context, global GDP, everything the world produces in a year, is around $100 trillion. The debt is 3 times the size of the entire world economy, and most of it will never be fully repaid. It will roll over, be refinanced, be restructured, change hands, mature into new instruments. It exists in a kind of permanent circulation, not vanishing, not multiplying uncontrollably, just moving, as long as the system maintains confidence. And that's the part they never quite say out loud. The whole thing is held together by belief, not by gold, not by land, not by oil, by the collective belief that the institutions managing this debt are credible, competent, and continuous. The moment that belief wavers, rates spike. The moment rates spike, debt service costs balloon. The moment debt service costs balloon, governments and companies start making choices that make the belief waver more. It's not a conspiracy. It's just a very elegant and very fragile system that has worked, more or less, for 300 years. By finding ways to restore confidence every time it breaks. Sometimes that's a central bank cutting rates. Sometimes it's a government bailout. Sometimes it's an emergency meeting at 2 in the morning between finance ministers who don't especially like each other. Sometimes it works. 2008 worked, barely. Sometimes it doesn't. Weimar Germany, Argentina, Zimbabwe. The line between managed and collapsed is thinner than most people want to know. So the next time someone tells you the national debt is a crisis that must be solved, remember Japan. Remember that debt is a technology, and like most technologies, it can be used brilliantly or recklessly. And the next time someone says debt is no big deal, just numbers on a screen, remember 2008. Remember that numbers on a screen can end jobs, end savings, end careers, and in some cases, end governments. The honest answer lives somewhere in the middle, in a place that's harder to tweet and harder to run on. The uncomfortable truth
is that debt is not a problem waiting to be fixed. It's the price we pay for living in the future.